Islamic Banking, Equity-Based Financing, PLS Mode. In this video, we will be discussing Musharaka, Sharing, Equity/Business Partnership, Joint Venture, Mudaraba, Trustee/Limited/Investment Partnership. Introduction. The bank generally acts as a financial intermediary between lenders and borrowers. By connecting savers to borrowers via various financial products, banks mobilize funds that impact on economic activities. However, Islamic financial institutions are less straightforward because the Sharia prohibits certain transactions. Islamic financial institutions are less straightforward because the Sharia prohibits certain transactions. Islam prohibits making money by money, and thus all transactions must not involve any interest, riba. Equity-based financing. Under Islamic banking there are two main fields of financing. One is equity-based financing and the second is debt-based financing. These modes of financing primarily differ from conventional financing due to their avoidance of interest. Role of Musharaka in Islamic finance. Musharaka is a partnership agreement whereby the Islamic bank provides funds, which are mixed with the funds of the business enterprise and sometimes others. Musharaka's contract does not envisage a fixed rate of return. Any profit is distributed among the partners in pre-agreed ratios, whereas any loss is borne strictly in proportion to respective capital contributions. Features of Musharaka. Parties should be capable of entering into a contract, that is, they should be of legal age. The contract must take place with the free consent of the parties, that is, without any duress. Sharing of losses. The potential asymmetry of profit distribution, however, does not occur in the event of a loss. There is a famous Islamic hadith stating this policy. Profit is based on the agreement of the parties, but loss is always subject to the ratio of investment. Home purchase. Diminishing musharaka. This method can be used in purchasing property or assets such as machinery for a factory. For example, under a diminishing musharaka contract, the bank, or financier, and the client become partners. The client must provide a significant amount of funds, e.g., 20% to purchase the house with the bank. The bank in this case owns the other 80%, which the client will pay over time in installments. Since the client will be living in the house, they will pay, on top of the installments, a certain percentage, e.g., 8%, in rent, ijara, to the bank for the share the bank owns. Over time, the client will own more equity in the house until it is completely bought, while the rent will decrease as the bank's share diminishes. Diminishing musharaka, musharaka mutanakisa. Bank's participation diminishes over time until customer becomes sole owner of the property. Mudaraba and please, pure Islamic banking. Mudaraba is a form of partnership in which one party provides the funds, while the other provides the expertise and management. The two parties share any profits between them according to pre-agreed ratios, but any loss is borne by the provider of the capital alone. Mudaraba, trustee or investment partnership. One partner with the funds, known as Rabul Mal, owner of wealth, and one partner is the mudarib, entrepreneur, fund manager. There can be more than one mudarib to work together as partners with the Rabul Mal, if the business or project is a success. The profit is shared according to a pre-agreed ratio. Typically, the Rabul Mal bears the risk of losing money, while the mudarib loses time and effort if the project does not bear fruit. The Rabul Mal may specify where they want the mudarib to invest their money, al-mudaraba al-muqayyada, specific or restricted mudaraba, for example, specific type of business of place. Otherwise, the mudarib is free to invest where they best see fit, al-mudaraba al-mutlaka, unrestricted or general investment, mudaraba, unrestricted by time, place, activity, and so on. Sharia characteristics of mudaraba. The division of profits between the two parties must necessarily be on a proportional basis and cannot be a lump sum or guaranteed return. The investor is not liable for losses beyond the capital he has contributed. The mudarib does not share in the monetary losses except for the loss of his own time and effort. The mudaraba can be general purpose, unrestricted mudaraba, or for a specific purpose, restricted mudaraba. Mudaraba, investment partnership. Profit cannot be a fixed amount for PLS financing, but must be determined by a pre-agreed ratio. In case of loss, the investor loses capital and the mudarib loses time and effort. In the case of proven negligence by the mudarib may be liable for capital as well. Murabaha. Murabaha means a profitable sale, and it is also sometimes called by bithaman ajil, meaning deferred payment sale. Murabaha, in this context, is essentially an installment sales contract for property. Debt-based financing or non-PLS modes. The following instruments are the most commonly used within IBF. They are the Sharia-compliant alternatives to interest-based modes of financing. Murabaha, cost plus sale, implies a markup in price. The merchandise is purchased. The buyer marks up the price and sells it to the customer and thus benefits from the profit. By bithaman ajil, BBA, murabaha, deferred payment. In the case of financing, murabaha is the useful alternative to conventional loans when it is combined with by bithaman ajil, BBA. By bithaman ajil, BBA, means sale with deferred payment and can also be known as by al-muajjal, which carries the same meaning. BBA and murabaha are similar concepts and are often used interchangeably, where murabaha is used for short-term and BBA represents long-term credit sale. When a customer seeks to purchase a product and is unable to pay up front, the customer may require the bank, or financier, to purchase the product. Thereafter, the bank, or financier, sells the product to the customer who will pay at a later date, in full or by installments, BBA. With a markup in price. The profit is a fixed amount agreed upon at the commencement of the contract. Under a murabaha contract, both parties are aware of the original price as well as the markup price. This is different from a typical everyday sale, muzawama, where costs and profit are not disclosed, like buying from the shop. Murabaha is one of the most widely used contracts at present in Islamic banking and the investment sector. The various products where murabaha is applied are as follows. Home financing. Vehicle financing. Working capital financing. Project financing. Goods financing. Trade financing, LC based on murabaha. Murabaha-based sukuk. Profit rate swaps. Islamic fund. Credit card. Ijara, leasing. Leasing entails that ownership remains that of the lessor and is to be transferred to the lessee by way of usufruct, i.e., the right to use it. The lessee pays the lessor for the duration of the contract at an agreed amount. Upon the close of an ijara contract, the lessee may return the assets to the owner. The lessee may sign another contract to continue leasing. The lessor may offer to sell the assets to the lessee under another contract. This is known as al-ijara thumma al-bai, atab. The lessor may give the asset as a gift to the lessee. This is referred to as al-ijara muntahiyya bidamlik, a contract of leasing ending with ownership. Ijara cannot be applied to money, or perishables, food, or other things that can be consumed, such as fuel. Ijara can also be used in reference to the services given by a person, such as a lawyer, who is paid by the hour for their services. By as-salam, deferred delivery sale, prepaid sale. When the Prophet came to Medina, the inhabitants used to pay in advance for dates to be delivered a year or two later. The Prophet told the people, whoever pays in advance for dates, to be delivered later, should pay it for a known specified weight and measure, of the dates. Another hadith mentions, for a specific period, collected by Bukhari. The other items that were sold in the lifetime of the Prophet under a salam sale included wheat, barley, and raisins. Selling agricultural produce in advance is permissible providing certain conditions are fulfilled. Some may refer to a salam contract as a forward contract. However, a forward contract involves a deferred payment as well as deferred delivery. Among the conditions of a salam contract is the upfront spot payment. This may help the farmer with the means of sustenance or for the finance needed to harvest the crops. As the hadiths above mention, the salam contract must stipulate a specified measure for a specific time period. Istisna is the second kind of sale where a commodity is transacted before it comes into existence. It means to order a manufacturer to manufacture a specific commodity for the purchaser. If the manufacturer undertakes to manufacture the goods for him, the transaction of istisna comes into existence. But it is necessary for the validity of istisna that the price is fixed with the consent of the parties and that necessary specification of the commodity, intended to be manufactured, is fully settled between them. Difference between istisna and salam. Subject: the subject of istisna is always a thing that needs manufacturing. While salam can be effected on anything, no matter whether it needs manufacturing or not. Advance price. It is necessary for salam that the price is paid in advance, while it is not necessary in istisna. Contract: the contract of salam, once effected, cannot be cancelled unilaterally, while the contract of istisna can be cancelled before the manufacturer starts the work. Time: the time of delivery is an essential part of the sale in salam, while it is not necessary in istisna that the time of the delivery is fixed. By al-istisna, manufacturing sale, this sale requires the manufacture, assembly, construction etc. of a specified item or items. This could be used for the production of electrical goods, machinery, a construction of a house, plane etc., unlike a salam sale. An istisna sale may consist of a deferred payment, lump sum or installments, depending on the agreement. By al-istijrar, supply sale, this involves the delivery of certain goods periodically over time. Likewise, the price can be paid periodically according to the agreement of both parties. A contract between a client and a supplier, whereby the supplier agrees to supply a particular product on an ongoing basis, for example monthly, at an agreed price and on the basis of an agreed mode of payment. Qard Hasan, benevolent loan. This is a loan that involves no interest. The principal is paid at a later date without any increase. If one borrows, they will repay at a later date. It is however legitimate for a borrower to pay more than the amount borrowed as long as it is not stated or agreed at the point of contract. Contentious instruments. The following products are used in some countries, yet, have received the most criticism from various scholars. By al-aina, back-to-back repurchase. One contract that comes under scrutiny is by al-aina. When someone requires money, they sell a product to the bank in receipt of cash. The seller then agrees to buy back the product from the bank at a higher price to be paid in the future, commonly through installments, BBA. Therefore, it includes a spot sale and a credit sale. Most scholars criticize this sale as a form of riba through the back door. The sale is artificial in order to receive cash. Likewise, the bank buys the goods momentarily for which it has no use. Likewise, al-aina involves two sales in one contract. The Prophet forbade two sales in one. In by al-aina, identity of the customer and supplier is the same. Customer ends up with cash, and deferred debt of is created. Profit in this case is not result of a genuine sale and is therefore indistinguishable from riba. This mechanism is used in some countries for credit card arrangements. By al-aina, repurchase. In by al-aina, identity of the customer and supplier is the same. Customer ends up with cash, and deferred debt of is created. Profit in this case is not result of a genuine sale and is therefore indistinguishable from riba. This mechanism is used in some countries for credit card arrangements. At-tawaruq, tripartite sale. Tawarik has been criticized as being related to alina in the sense that it is seen as a means to bypass riba. Others may see it as a legitimate sale, some scholars do not. Those who tolerate this sale may do so based on the individual's need for instant cash, providing certain conditions are met. Unlike alina, which involves only 2 parties, 3 parties are involved in tawarik. For example, the customer seeking cash approaches the bank. The bank buys a product from a vendor, then sells it to the customer BBA murabaha, markup sale with deferred payments. The customer agrees and then requires the bank, now as an agent, to sell it to a vendor on their behalf in order to receive cash. The customer gains liquidity. Yet now they have a higher debt to pay at a later date. In alina, identity of the customer A and supplier is the same, while in tawarik it is not. Customer A ends up with cash that is result of a genuine sale to customer B. This mechanism is used in some countries for credit card arrangements. However, organized tawarik where good supplier and customer B have same identity may resemble alina transaction. Al-dain, sale of debt, bill discounting. The Sharia promotes investment in tangible assets as opposed to investment in debts. The only exception put forward, by the Shafi'i school, for the sale of debt is when the debt is sold off, or passed on, at par value without any discount. This condition is necessary in order to prevent any form of riba, interest. In the following weeks we will look at how some of these mechanisms have been applied in the Islamic banking industry. Note: selling more money, later, for less money, now. Transfer of debt only allowed at par value in order to prevent creation of riba, interest. Thank you.